This week on The Art of Boring, Part 3, the final installment of our series on memory with equity analyst Shun Yo. Parts 1 and 2 traced the history of the memory industry, what's led to massive bottlenecks in supply and demand, and some of the bigger potential disruptors to the outlook. Today, Shun puts it all together. As an equity analyst, what he's watching most carefully, the scenarios he's thinking the hardest about, how leveraged ETFs are amplifying stock price movements, and how we're thinking about position sizing. Enjoy. I mean, it just strikes me that, number one, the numbers are huge. The deltas are huge in terms of the change. Because of the cyclicality, talking in some cases about, is it 27, is it 28, is it 2030? When you think about individual investment cases, maybe you can share an example from something that we own. What are the key variables when it comes to us valuing these businesses? And how are we thinking about the probabilities associated with just how they could evolve?
So this is definitely one of the more difficult business to project. Business as uncertain as memory, with all these demand changes that we could not project, and also the risk from like China, technological changes or oversupply. So I think the truth is no one truly know what DRAM prices will be this year, next year, and definitely not in 2029 or 2030. So fortunately for us, I think we have this Monte Carlo simulation framework where it allows us to take into account probabilities. And we have to in this case because we cannot discount any of these probabilities away. I think you could argue that there is a more bullish scenario where memory prices continues to stay high through the decade. And there could also be a more bearish scenario where price decline starts in 2028 and it just accelerates downwards just because of how much capacity these guys have invested. So rather than pretending that we know everything or that we think that it will be a bull case, a bear case, no, we build a discounted cash flow where all these key uncertain variables are a range of numbers, and then we run the model through thousands of scenarios so that instead of giving us a single point, it gives us a distribution of outcome. And no, these are treated stochastically. Each is a range and a distribution. So no, just walk through SK Hynix as an example. So I think ultimately the most important variable here is the path of DRAM prices. So in our more bullish scenario, I think memory prices rise further in 2027 and just hold at the level until 2030 and beyond before it starts to decline, right? Because we do believe that DRAM is still a cyclical commodity. So this is a scenario where AI demand continues to grow, HBM consumes a huge part of DRAM supplies, and customers stick to the LTAs. In a more realistic scenario, I think we project that maybe price starts to decline in 2028. As normal historical patterns that the supply response arrive on schedule, demand supply becomes more balanced, and we get the usual cycles. And the memory suppliers exhibit some of the capital discipline that they have exhibited in the previous cycles. And of course, in a more bearish scenario, I think that this decline accelerates through 2028 with overinvestments, Chinese supply, and the demand air pockets that land all together. So I think these are all possible scenarios that we cannot discount. And for us, the output we focus on is the investment rate of return distribution. So what annual returns do we actually earn at today's price under different scenarios? So for SK Hynix, the distribution runs from about 9.5% the very worst to about 15% the best case and center around 12%. So even in the pessimistic tilt assumption of the 10th percentile, I think we still get paid a reasonable IRR. So the question is not about which scenario is right or we think will happen, but in this case that we are being paid adequately across the whole distribution with a positive skew on the upside. I think despite the run up in the share price, I think market is still pricing in a fairly harsh memory cycles. So beyond this, I think every new data point, which is important given how rapid the industry change, whether it's the progress of more LTAs signed or more capacity expansion, this became signal for us to update to our distributions. And position sizing, I think, follows from the shape of the distribution. So I think as the share price has gone up, I think what we have done is, I think across the portfolio, we have taken the position down over time based on just the risk reward that we are getting from it.
Of course, that's taken a lot of work to do that. Just given how much the share price has gone up. Can I ask? I mean, just we've seen such day-to-day volatility in those share prices, which I assume there's some fundamental basis for that. If you mentioned earlier just the risks on the terminal value or just the timing of when these contracts might change, presumably do have that kind of an impact, even in our Monte Carlo on the value of the stock. But I would also think that, and we've seen this just through retail participation and some of these single stock ETFs that are leveraged that really play on, how well this particular stock is going to do. Do you think at all about more, I guess, more the technical side of things in terms of flows and just the day-to-day nature of how these stocks are trading? How does that factor into your longer term analysis?
I think the flow and technical aspect has become a lot more visible since June onwards. So I think what really changed was the presence of multiple leverage ETF that came in May. So this leverage ETF allows retail participants to ride on the very rapid price appreciation. So I think the volatility has gone up significantly since June as a result of this leverage ETF. And I think there's some technical aspect here where how this leverage ETF amplify the volatility. So a lot of these are 2 times single stock ETF, like 2 times SK Hynix ETF listed in the Hong Kong exchange. It has about 25 billion AUM at the peak. So leverage up, it has about 50 billion of gross exposure to SK Hynix. So what happened is that when the SK Hynix share price goes up, at the end of the day, the leverage ETF has to come in to buy to rebalance it. Because let's say the NAV is $100, the gross value is $200. The underlying share price went up by 10%. The NAV went from 100 to 110. And the gross value went from 200 to 220. But in order to maintain the 2 times leverage, they must leverage it up from 220 to 240. So when the share price goes up, they have to come in at the end of the market to buy even more. So that's what we've seen in the early part of June, where you see SK Hynix goes up and down by 15%, 10 to 15% every single day. So as this leverage ETF gains AUM. And what we've seen in the last 2 weeks is that when the share price starts to fall, this leverage ETF becomes forced seller. Though usually we buy low, sell high, I think what this ETF does is they buy high and they sell low. So it really amplifies the volatility both ways. So I think for long-term investors like us, I think it is actually a gift because it actually widens the gap of price and value. So for us, it's, if the risk reward from our distribution starts to go down, I think we will trim our position. And when the risk reward starts to look better, maybe it's time for us to explore whether we should take advantage of the volatility. So there is definitely that aspect of the leverage ETF. And of course, there is the leverage on the retail side in Korea, where I think the retail participation rate has gone up significantly and has the retail balance. So I think the Korean government is exploring steps to try to control this leverage taken. We have also seen the Korean brokers proactively try to increase the maintenance ratio so that to reduce the margin risk for the retail investors. So yeah, it's definitely very interesting times that we see all this volatility where 10 to 15% daily price movement is the norm these days.
Shanna, I want to end with, throughout all this discussion, what is something either that we've mentioned or maybe that we haven't that you think is really underappreciated by most people out there about this particular market?
I would say memory is definitely still a cyclical commodity, but I think DRAM is a wealth creating industry and you can be all three at the same time. You can be an industry with structural growth, with a lot of cyclicality, but you can still have all these companies that create returns of capital that is more than the cost of capital over the cycles.
And I guess that's the key in industries like this is making sure that, okay, there are going to be moments in the cycle that are more or less wealth creating, but it's really about over the cycle for it to meet our investment criteria and for us to participate. Well, Sean, we had went on the podcast a couple of weeks ago, and he described you as a walking LLM in terms of your own ability to source memory. Certainly a lot of high bandwidth memory in my experience chatting with you. Love the detail that you brought to the conversation. Thanks so much for spending the time, I guess early in the morning in Singapore to speak to us and our listeners. Thanks so much.
Thanks, Ro, for your time too. I think you should have a good rest.
Will do.
Thank you.
Thanks, Sean.